All right, let's just dive right into this fascinating evolution happening in Vietnam's financial landscape and decode all the buzz surrounding the Ministry of Finance's new Circular 99. Now, if you operate a business in Vietnam, or maybe you're an international investor looking at the region, you have undoubtedly heard about this shift. It is a massive update to how businesses report their financial health, and it's got literally everyone, from local accountants to global CFOs, talking. But there's still a lot of confusion out there about what it actually means for the day-to-day reality of running a business.
First things first, while Circular 99 is a huge step forward for transparency, I want to immediately clear up a really common misconception. It is absolutely not equivalent to International Financial Reporting Standards, or IFRS. Sure, it's a modernized framework, but it is a uniquely Vietnamese framework. Assuming they're identical, that's a trap, and it could severely impact your entire financial strategy. To see exactly why that is, here's our roadmap for this explainer. We're going to look at the two different financial worlds, dig into the philosophy of rules versus principles, look at some real-world accounting impacts, tackle the transition challenge, and finally, figure out how to choose your framework. Let's get to it.
All right, part one, two different financial worlds, statutory compliance versus global investment. This really highlights the core philosophical divide we're dealing with. Circular 99, it's basically a rulebook written for local tax authorities. IFRS acts more like a global compass designed specifically for investors and creditors. Think of Circular 99 as a tool for the government. The state wants standard, predictable reporting that makes tax administration straightforward, right? They want everyone filling out the forms the exact same way. IFRS, on the other hand, is built by the International Accounting Standards Board, and its ultimate customer is the global capital market. It completely prioritizes giving investors the most accurate, fair presentation of a company's economic reality so they can make informed decisions.
Moving right along into part two, philosophy. Rules versus principles, or as I like to think of it, the checklist versus the compass. Here's the crucial takeaway. Circular 99 gives you rigid predictability by sticking mostly to historical costs, while IFRS demands real professional judgment to reflect true, real-time market economics. Because Circular 99 is rule-based, you have very little flexibility. Say you bought a building 10 years ago. You're generally just going to record what you paid for it back then. It's safe, it's standardized, but let's be honest, it probably doesn't reflect the reality of today's market. IFRS totally flips this on its head. It's principled-based. It actually gives management the flexibility to format statements in a way that tells the true story of the business, valuing economic substance over mere legal form. But with all that flexibility comes the heavy burden of professional judgment. Now, you are going to hear the term fair value constantly when talking about IFRS. It's this dynamic measurement that can definitely cause some earnings volatility, sure, but it provides a vastly more accurate picture of what a company is worth at this exact moment. Instead of that rigid historical cost, IFRS 13 actually requires you to look at the market. What are quoted prices doing right now? What are the observable inputs? This means your balance sheet literally breathes with the market. It might be a headache to calculate, but an investor looking at your books knows exactly what your assets are worth today, not a decade ago. Okay, part three. Let's bring this down to earth with some real-world accounting impacts. A tale of two cities. What's really fascinating about a simple software sale is how it perfectly highlights the strict focus IFRS places on transferring control over time, rather than just, checking off an invoice date. Under Circular 99, if you sell software and a year of tech support, you often just look at the invoice, treat the whole thing as one contract, and boom, book that revenue right away. Super simple. But IFRS 15 steps in and says, wait a minute, you haven't actually provided that tech support yet, so you have to separate the contract. You recognize the software license money today, but you have to drip that support revenue into your books over the next 12 months as you actually do the work. It perfectly maps your revenue to your actual effort.
Before we look at our next example, we really need to talk about ECL, or expected credit loss. This forces companies to be proactive and forward-looking about the risk of customers not paying their bills. In the old statutory world, you basically wait until a client goes bankrupt or ghosts you completely before you write off the debt. It's a reactive, incurred loss model. But under IFRS 9, the absolute moment you issue an invoice, you have to use data to estimate the likelihood they won't pay, and you recognize that expected loss immediately. It's incredibly conservative, and honestly, it prevents a lot of nasty surprises for your investors down the road.
This whole paradigm shift gets super obvious when you look at lease accounting. Under IFRS, signing a 5-year office lease massively inflates both your reported assets and your liabilities, which fundamentally alters your leverage ratios. Under Circular 99, renting an office is just an operating lease. It doesn't touch your balance sheet. You simply record your rent expense every month and move on. But under IFRS 16, signing that same lease means you now control an asset for 5 years, and you owe 5 years of payments. So you must add a massive right-of-use asset and a corresponding lease liability straight onto your balance sheet. For a bank or an investor who is evaluating your debt-to-equity ratio, this is a night and day difference.
Or say your company buys an aircraft. Under Circular 99, you generally just put one airplane on the books and depreciate it simply over, say, 20 years. But IAS 16 under IFRS, it requires you to break down and depreciate the plane piece by piece. The engines, the fuselage, the landing gear. Why? Because it knows the engines wear out a lot faster than the main body of the plane. So when you eventually replace an engine, you don't just expense it as a quick repair. You actually de-recognize the old engine's value and capitalize the new one. It definitely requires a lot more tracking, but the financial story it tells is just incredibly precise.
Which brings us to part 4, the transition challenge, upgrading systems and mindsets. Listen, shifting to IFRS is definitely not just about memorizing a new rulebook. It is a complete operational overhaul. You're talking about upgrading your IT infrastructure, intensive staff training, and learning how to document and defend subjective management judgments. Think about the data you're going to need. Your current ERP system probably has no idea how to track right-of-use assets for every single lease you hold. It doesn't have the predictive models for expected credit losses. You have to build all of that. You have to train your staff to think in terms of economic principles rather than just looking up a tax rule. And realistically, you're going to need external valuation experts to help you calculate that fair value accurately. Ultimately, what we are talking about here is a massive transformation. You are moving from just checking boxes on a compliance list to actually mastering financial storytelling based on economic reality. Your finance team has to transition from being, frankly, data entry clerks for the tax authority into strategic analysts who can justify their professional judgments to global auditors and savvy investors. And finally, part 5, choosing your framework, finding that strategic alignment. Here's the thing. Neither framework is universally better than the other. It's all about context. A mom-and-pop shop is going to thrive on Circular 99, while a tech startup eyeing an international IPO absolutely must adopt IFRS. If you're a small domestic enterprise, Circular 99 is exactly what you need to stay compliant and keep your accounting costs down. If you're a subsidiary of a massive multinational, well, you're likely living in both worlds. Circular 99 for your local filings and IFRS for your parent company's consolidated reports. But if you are trying to raise money from global venture capitalists or aiming for an IPO, IFRS is completely non-negotiable. Global investors need to compare apples to apples. So, weighing it all out, Circular 99 absolutely protects your bottom line when it comes to implementation costs, while IFRS acts as an investment that unlocks global capital and cross-border M&A opportunities. You really have to weigh the immediate operational headache and the cost of an IFRS transition against the long-term strategic value of speaking the global language of finance. If your growth depends on international trust, IFRS is the key to building that trust through unparalleled transparency. So as Vietnam continues marching toward international convergence, you've really got to ask yourself, is your business preparing for a global future? And more importantly, is your financial reporting ready to tell that story? Because eventually, the way you measure your success might be just as important as the success itself. Thanks for diving into this explainer with me. Keep learning, keep growing, and make sure your numbers are telling the right story.